Hello, good evening. After a very long time, again, Mohammed Aashikkhan from the GBS. I'm the managing director and the technical partner on various financial accounting, financial management, auditing, and other pillar related subjects. Anyway, we are now almost heading to finish our Ramadan. For all the viewers, I wish you happy Eid. And today I thought of picking up one particular standard, a portion of this standard actually, IAS 12. Especially I wanted to discuss this temporary difference because many of the students are really finding difficulty in understanding the interpretation of the standard as to what this temporary difference is. Let's go through slowly or gradually. First, as an accounting student, we all know what is an accounting profit. Accounting profit are the net profits that we calculated as per the rules of IFRS. Now, we know that we have sales, we have cost of sales, so we will subtract the cost of sales and then we will arrive the gross profit, and then we will subtract expenses. So once we subtract expenses and then we will take it this net profit. Based on previous knowledge on our IFRS and all other basic concepts related to accounting, we know how to prepare this. On the other hand, as a tax authorities, they will produce their own way of preparing profit or loss for the purpose of tax requirements. The tax, that is, we call it taxable profit. The profit calculated based on tax authorities regulation. Every country or every regime, they will have their own regulation, their own tax rules or their own tax law. I would call them tax law, tax regime, tax regulation. So according to their tax regulation, we have to prepare and calculate the tax, that amount that for the year against our taxable profit. So first we need to calculate the taxable profit. So the profit calculated based on the tax authorities regulation. So that is what you call it, taxable profit. Okay, now it's clear. The calculating accounting profit is a job of the financial accountant, whereas the calculating the taxable profit usually a job of the tax consultant. And sometimes in some companies, if the company is quite large, sorry for that, quite large, then the company will have their own tax specialist who will produce the taxable profit. However, small to medium entities, they will seek the help and support of the specialists who are practicing as tax consultants. They will approach them and they will calculate based on their expertise, knowledge, skills and all that, and the regulation as referred in the tax laws. Now the interesting scenario here, generally there is always a difference between accounting profit and taxable profit. There is always between accounting profit and taxable profit. So that is the thing that makes the preparers of financial statement a big issue. Preparers of financial statement a big issue. Just a minute, referring a small note. So that's the fact that that we need to emphasize on. So, accordingly, an accountant has to produce a reconciliation. What will happen is, after the basic preparers of financial statement, they will produce this accounting profit, and they will then submit this to the tax specialist, who will come up with their own taxable profit, and which needed to be reconciled. A reconciliation of accounting profits to taxable profits are generally carried out. So, reconciliation of accounting profits to taxable profits are generally carried out. Now, how that generally will happen? We will start with accounting profit. Based on the tax law, based on the knowledge and skills and experience of the tax consultants, they will suggest that some of the items that we listed as expenses as per IFRS, but the tax authorities say no, we will not accept this, so we will disallow this. There are good examples like depreciation, accounting depreciation they will not accept, donation they will not accept, entertainment expense. Now regarding donation, how that will work, unless otherwise, if you have donation to authorized charities, they will not accept. And entertainment expense, the tax authorities will not accept, and also road tax on luxury cars, that will also not, they will not accept. Now especially with regard to tax in ACCA syllabus, there is another subject F6. Also in Sri Lankan Charter there is a separate subject on taxation. So students who need more knowledge and expertise on taxation, please do refer those subjects or the videos related to that. But here the scope is to talk about the accounting implication on taxation. So we will have to add back the disallowed expenses. We will add back the disallowed expense, and also in arriving our profit, sometimes we may also add some income which the tax department may not accept. Example I'll give you. If I include in accrued income, now one of the tax rule is that they will recognize revenue only by when you have received the cash. When you receive the cash, whereas according to IFRS financials, we don't wait until to receive the cash. As long as we justify that according to IFRS 15, the revenue is meeting the condition to recognize the revenue, then we need to recognize regardless of when we are receiving the cash. But the tax authorities are different. They say that, my friend, no, we can't accept that. We will wait until you receive the revenue in cash. Once the revenue is recognized in cash or monetary terms, then only they will recognize. So therefore, we may have to subtract some of the taxable or disallowed income, and this will arrive taxable profit. Now you see here, I have accounting profit and I have taxable profit. That means I have two items in my hand. Both are not equal. So based on the table among the disallowed expenses and disallowed income, some of them are permanent in nature. What I mean by permanent in nature, that means that once you subtract or once you disallow, the tax department says we will not accept, they are not going to accept for any time. Throughout the entire life of the business, that will not be reverted or reversed or re-accepted. These type of expenses are known as, or these type of items are known as permanent item. Because of that, there is a difference. This difference we call it permanent difference. While some other items are temporary. Good example is the depreciation. Now, under accounting principle, we follow IAS 16 in calculating depreciation. And we say that either we will follow the straight line method or reducing balance method. And we also have lifetime, 5 years, 10 years, 20 years. Whereas the tax authorities say that we will give you tax depreciation or capital allowance or tax allowances on those property, plant and equipment that you are using. And these two time periods may not coincide. If I pick an example, let's say you have a motor vehicle. This, according to accounting, the lifetime is 5 years, whereas according to tax practice, the lifetime is 4 years. But if you take a complete time period of 5 years, in both cases, in accounting or tax cases, we would have been totally utilized the asset. So, in this situation, this type of items are known as temporary difference. Accordingly, the difference between accounting profits and taxable profits, the differences are categorized as follows. One is known as permanent difference, which I have discussed just right now. The other one is known as temporary differences. Anyway, permanent difference. These differences are different which will not reverse between both accounting profits and taxable profits. Some good examples are unapproved charity expenses, entertainment expenses, advertisement expenses, road and vehicle tax for luxury cars, and so on. So, if you generate a profit and loss account, you see, if it is my IFRS P&L, and under my expense categories, I will have these expenses. I may have other expenses. Apart from other expenses, I have unapproved charity expense, I have entertainment expense, I have advertisement expense, and also I have road tax and road and vehicle tax for luxury cars. So these expenses I will subtract in arriving the accounting net profit. Remember, please note that this is accounting net profit. Then when we are doing the reconciliation for the tax, we need to add back those permanent differences which I have written there, number 1, number 2, number 3, number 4. These are permanent difference. So then we will arrive at taxable profit or loss. However, these we will not reverse it in the future. These above items will not be reversed in any future years. On the other hand, we also do have temporary difference. These differences will be arised between accounting profit and taxable profits in any given accounting year, while will be reversed in future years. Here, one important aspect that the IAS 12 discussing is about the tax base. So, what is a tax base? A tax base of an asset or a liability is the amount that is attributed to that particular asset or liability for tax purposes. Using the finding out the difference, the accounting carrying value and the tax base will result into temporary difference. Now, when I have accounting carrying value minus tax base, this will result into temporary difference. So the temporary differences are two types. I have taxable temporary difference and deductible temporary difference. Just to make yourself more understandable, I pick one example for taxable temporary difference. A company purchased a motor vehicle for $1 million on 1 January 2015, and the estimated useful life is 5 years. The tax allowable depreciation is 4 years and no residual value. Now we just follow the following summary. Following is the summary of the P&L that was being prepared for by the accountant. Now we have the profit before tax 500,000, 500,000, 500,000, 500,000, 500,000. For the sake of convenience, I have taken the numbers equal. And as we understood that now we go down and we calculate depreciation. Now you see here, accounting depreciation is per year 200,000. So I will add back. Now this 500,000, please remember, I have already subtracted the depreciation. Now I am adding back the depreciation in order to calculate the taxable profit. So I am adding back 200,000, 200,000, 200,000, 200,000 and 200,000. And then we also need to know how much is the taxable depreciation. You see, please note that here the asset will last for 4 years. So therefore, I will then subtract the taxable temporary difference on 4 years. 250, 250, 250, and the last year it is 0. Accordingly, my taxable profit will be 450, 450, 450, 450 and 700,000. Now you see, the tax rate given in the question or in this example is 30%. Accordingly, from a reconciled basis, the tax accountant's calculation, I will have a tax liability of 135,000 each year. 135,000, 135,000, 135,000. But please note that in the fifth year, your tax liability comes to 210. In early years, accountants could be very happy. Early years, accountants could be very happy. Why? Their tax liability is very less, 135,000. But once we are reaching to the later part of the period of the asset, especially in this case the final year, the tax liability suddenly shooting up or rocketing up or increase to 210,000. So this is sort of an imbalance. In order to smooth out this, IAS 12 suggests that you please introduce something called deferred tax. Now, what do you mean by deferred tax? When we have a temporary difference and that difference will result into additional taxes, which we call it taxable temporary difference. And for that amount is what you call deferred tax. If you go down, you see, I have my accounting depreciation 200,000, 200,000, 200,000, 200,000 and 200,000. For the 5 years, my accounting profit is 200,000. Whereas my tax depreciation is 250, 250, 250, 250. But in the last year, surprisingly, my tax depreciation is 0. So accordingly, the difference, the temporary difference, this difference will take a cycle. It is like this, that if I draw a cycle like this, and if you take the total this length of this, and this will result into a circle like this. So, and when we are at here this point, it doesn't mean that we will not recover the rest. So we have a plus effect here and a minus effect here. The total becomes 0. So likewise, this temporary difference will also give us the same pattern. So now for this 50,000, my tax implication is 30%. 30% of 50,000 is 15, 15, 15, 15. And the last year you see the 60,000. But for the first 4 years, my answer is minus. In the sense, I need to increase my tax provision. Okay, my tax expense will increase. But please remember, due to temporary difference, we will not end up paying additional tax liability. Tax liability is simply based on the current tax, on the calculated taxable profit done by the tax authorities. Whereas the deferred tax is a calculation done by accountants. It has got nothing to do with the tax authorities, and that is an accounting work. It's a double entry. It's a mere book entry, and there is no cash flow involvement for the deferred tax. So we now go to the IFRS profit and loss account. You see, we will have to prepare the IFRS profit and loss account, and then I have the profit before tax 500, 500, 500, 500. As per the tax authorities calculation, I have calculated the tax liability 135, 135, 135, and suddenly a boom of 210,000 in the year 5. On the other hand, deferred tax. You see my deferred tax, as we calculated here, the minus, same minus I am bringing here. First year 15,000, second year 15,000, third year 15,000, fourth year also 15,000. But at the last year, 60,000, but it's a plus. Now let's calculate the profit after tax. You see, 500,000 minus 135 minus 15, it will give me 350. In the year 1, 350, year 2, 350, year 3 also 350, year 4 also 350. But in year 5, my tax liability has increased to 210, but we smoothing out that by introducing additional saving of 60,000, which has been accumulated over the last 4 years to use in a rainy day. later when my liability, my expense, not liability, my expense seems to hitting my P&L, and accordingly my profit is shaking. In order to safeguard such a shake, we introduce that sort of a platform, and then the 60,000 will reverse. Early 4 years, we have created such a provision as a sort of a protection mechanism for my profits, so that no shareholder is given a very wrong picture. If you see 500,000 minus 135, we are getting how much? 365,000. So every year I'm going to get 365,000, 15,000 profits will more based on this example. So then the shareholder may anticipate for an additional dividends, which is then what's going to happen later part of the year when the tax difference, this temporary difference, could start reverse it, and then I may then have a very little profit. Then the shareholder, I am unable to give such a keep the confidence or the expectation of the shareholder in that time. In order to keep the profits smooth out, in order to maintain the shareholder's expectation normal, we do this. If you look into the accounting double entry for this, see this I have just done it for the tax expense account and the tax liability account, and also at the bottom I have the deferred tax account. Please note that tax liability, this amount only will be subject to cash flow. This is what we have to pay for the department, and this 15,000 is an additional sort of a protection, sort of a fat, that or sort of a muscle I am creating in order to safeguard my profits. Understand me? So therefore, we year by year, based on this example, we charge tax liability, and also we introduce the deferred tax, and then accordingly we pass the entry. Here what is most important for you, look now, the first year my liability is 15, deferred tax liability 15 has been brought down next year as opening balance, and then again 15,000, and that I bring it down to the third year as an opening balance for 30, and the fourth year again I will introduce another 15, so that 45,000 comes down as opening balance, and then again another 15, that will bring me at the end of the fourth year 60,000 as the liability. But on the fifth year I am reversing this. Is exactly what we are discussing about taxable temporary difference. Please tune on my YouTube channel, and in order to get more benefits and knowledge, especially on these areas, and I will discuss the next part of the video on deductible temporary difference. Before that, I will read out this for you. When any temporary difference resulting to reduce the tax liability in the early years, while excessive tax liability in the later years. As a matter of prudent accounting practice, the preparers of financial statements should incorporate that tax implication of the temporary differences. As a result, such a differences has been taxed, and the total tax expenses have been increased, and to smooth out the tax consequences of the profit. This will result into a deferred tax liability. With that, I am going to sign off, but before that, please like my videos, subscribe all my videos, my YouTube channel especially, and please press the my bell button, you find it down, and share to everyone who will benefit from. And if you are having any doubts or any concerns or questions on this video or any other related video, please contact me on +94 777 654509. WhatsApp, Viber, email, everything is working here. Or contact me on my email ID atif83@gmail.com. Or also, what you could do is you can drop a comment in my below my video. I would be very happy to have any such comment. If any feedback you could give me to improve the quality of the content that I am delivering, I'm very happy to accept that as well. Thank you so much, and have a nice day, And if I don't see you before the Eid, happy Eid to everybody and good night.